Today I want to talk about, given the move in the 10-year bond on Friday, are we indicating now that we're definitely heading for a recession? And as you know, people are now saying the Fed is going to cut 50 basis points 3 months in a row, which kind of makes sense what they're looking at. What we have to decide is, does it make sense what they think is going to happen? Because when our bonds are at 380, we'll say, just to make it easy, and we're at 533, let's make it 5.25. So you take 50 off, 475, 4.25, 375. So even with 3 cuts, we basically have a flat yield curve. So why don't we take a look, because we now have hit, as of Friday, an historic number on the inverted yield curve of 1.62%. So what do I mean by that? Well, here's our Fed funds rate, and as you can see, it's 533. And here's the 10-year bond, 3.791. Well, if you minus the 3.79 from the 533, you get 154. And so on Friday, we hit 162. Now, you can see at the top of the kind of like orange or yellow line up there, a little dip there. So that's the difference between the 162 and the 154. But this chart is saying one thing. 3 other times in history, we've hit 162. Every single one of those times, the market has corrected and gold has doubled, okay? So the question is are we now entered into a correction because we hit the 162, or should we expect a correction because we hit the 162? Should be noted though, in my opinion, if you go back, the 3 episodes before were 2000, dot-com bubble, the great financial crisis, and COVID, okay? There are the 3 times we hit 162. So there's nothing going on in our world that resembles COVID, because as you know, COVID was totally different, all right? And when we shut down the entire country, everyone thought we were going to go into a major recession, and so thereby we got an inverted yield curve. Then you go back to the great financial crisis. I also think this is a currency, because right before the crisis, we experienced something we never have before, and that was a major oil crisis, where oil basically went up to $150 a barrel, and we started with the petrodollars and all this other stuff, okay? And then even if you go back to the dot-com bubble, right before the dot-com bubble, we had the Asian flu currency crisis. So all 3 of these, and by the way, even on COVID, it in many ways was a currency crisis, because as we went into this recession, we had to throw in huge amounts of money, which we did, $6 trillion, to reverse it and pull ourselves out of it. So the question is this: the 162, does that represent that we should now expect that we're going to go into a recession and the stock market goes down? All right. So even though we hit 162, and we can now see those 3 crises before where we hit 162, but that's not showing the 162. That's showing the credit spreads. So in other words, the credit spreads widen out, i.e. the better stuff, AAA, is better priced than the things that are, let's say, B or C or whatever, right? High yield versus AAA rated, okay? So what they're saying here is that when the market is stressed, people buy the good stuff and they sell the bad stuff. Everyone does it. Obviously, we're really not under that much stress in the credit markets, okay? And in fact is we have had a small uptick here in the last couple days, but even on the bottom there, we haven't moved at all. So is the financial structure of our markets, bond and stocks, under stress? And I would answer, I don't think so. What do you think? So there's been a lot of comments, thank you very much, on the previous video concerning what's going on with the 10-year and the yen. But when you think about it, okay, so if those guys are right by issuing the treasuries 80% over the last 12 months, that we have stealth QE, the 10-year bond at lower rates. So even before this drop in the last couple days, we were way below where they should be. So if you had a 533, you get a quarter because it's not a T-bill, and you get a 0.5% for what they call terms. That's 75 basis points. So really what we should be, the long-term bond should have been around 6%, 610, 620 this whole time. But as we're well aware, it was basically like 450, a 1.5 lower, okay? And our belief is because there's a scarcity of the 10-year bond because of our issuance of the treasuries, so thereby people, institutions, buying the 10-year bond so they can leverage it up, they've artificially pushed down the rates. Now, the rates have dropped again, huge on Friday, which dropped the mortgages down to a 14-month low. Again, the question is why is the 10-year going down? Because the mortgages is off the 10-year. It's not off of the T-bills. Okay, a lot of moving parts. What does this mean to us? Here's what we have to start deciding. Do you look at these people and say we hit 162, now gold's gonna double and market's gonna crash, okay? Or is there a scenario out there where we're gonna see like waves of selling and going back and forth, okay? The tides come in, the tides go out, as institutions around the world redo their yen carry trade. So was Thursday and Friday more of a day where an institution made a move out of the US stocks and then went and covered their bonds over in Japan? You know, we won't know, not now, but we will find out eventually. So the question then is what are we really facing here? Is the 10-year artificially low because of Treasury issuance, thereby we're not heading into recession, we're not looking at a correction, and we're not looking at a doubling in gold? Or just the mere fact that we went to a 162 differential on the inverted yield curve, which 3 times previously has caused a recession and the doubling of gold? Is that the way we're gonna go? What do you think? Like and follow, and certainly tell me in your comments what you think.